In this lecture, I want to show you on the put options the different things that we looked at when we looked at the call options. So one of the things was we looked at the intrinsic and extrinsic values in call options. So just like we did in call options, we can come here and we can change our column layout to show the intrinsic and extrinsic values. So again, we have the at the money options right here. And then on the call side, we had out of the money options, which were all zero. If any option is out of the money, its intrinsic value is going to be zero. Similarly, now you can see it's diagonally opposite on the put side. And that's because all these strike prices are less than the stock price. So Apple has to go there for these strike prices to become in the money. If you look at the strike prices above 470 to about 510, these strike prices are already in the money when you look at the put side. And that's because Apple has already gone below these strike prices. So the way you visualize calls and puts is exactly the opposite. And it will take a few times. This can be the somewhat challenging part in trying to conceptualize puts. But remember, when you're talking about puts, your mindset should be that the stock is going to move down. So the way you look at it is this way. So you're going to go up vertically on the screen. Whereas when you're looking at calls, you're looking at the stock price moving up. So in that case, you're going to be moving down the screen in this direction. And when you look at in this direction, you can see that the stock is right here. It's near 465. So these options are all going to be in the money puts. And so now you can see that all the out of the money puts all have an intrinsic value of 0. If you look at the in the money, we were looking at the 510. So let's just look at the 510. The 510 total option value is somewhere between $46 and $46.40. Out of this value, the intrinsic value is almost 90% of that option value. And the extrinsic value is only $3.21. Now, when we look at time decay in the next course, you'll see why this makes a big difference. And I can tell you one thing right away, that it may or may not make a lot of sense right now, but if you just look at this extrinsic value, and I've mentioned a couple of times that time decay only has an impact on the extrinsic value. So let's just look at this extrinsic value and see what kind of a pattern exists here. So here on the 510 put, we have the extrinsic value of 3.21. The next strike is 505, and that goes up to 3.91. So you can see the pattern. The extrinsic value increases as you approach at the money options. And it's at the money options that have the maximum extrinsic value. And then again, as you go out towards more out of the money put options, you'll see that the extrinsic value reduces again. You'll see a similar pattern on the call side as well. The maximum extrinsic value are going to be in the at the money options, and then it starts decreasing in both directions, and that's exactly what you'll see. So this has some major implications when we look at time decay strategies. So I don't want to jump the gun here and talk too much about it, but I just wanted to point out this particular pattern. Okay, so now what we're going to do is quickly look at the risk and reward profile. So let's say we wanted to buy the 465 put. So what I'm going to do is just click on the ask, and that puts up 10 contracts of the 465 put. So why would you buy something like this? Well, you would buy something like this, this kind of an option, if you felt Apple was going to go down further. So, here we have 30 days. If you felt that in the next 30 days, Apple was going to go down, then you would buy a put option. And you would buy this put option for $14.40, and that would take up a margin of $14,400. So if you bought this put option, then you look at the risk profile. And now, if you recall our slide, this is what a put option buyer looks like. We bought the 465, and at this strike price, we are going to be at a negative because we've spent $14.40 on this option. But that's going to be our maximum loss. So if Apple does not go down, if it starts going up, then you can see that our maximum loss is 14,400 because that's what you paid for the option, and that is the maximum you can lose. However, if Apple turns down and goes down, which is what you expect when you buy a put option, you can see that your profits are unlimited all the way up to zero. And where is your break even? You take the 465 and then you minus the premium. So 465 minus 1440 is going to be about $450. And that's where your break even comes in. And anything beyond that on the day of expiry is going to be profit for you. But like we mentioned in the previous course in call options, if you really want to see how your option is going to perform today or tomorrow or the day after, you're really looking at the white line. So in the next couple of days, let's say Apple went down by $10 to about $455, then you're immediately going to see a profit of about $4,000 to $5,000 on this position. Even though it's not gone past the break-even point, it doesn't matter because the break-even point is only valid on the day of expiry. These options still have a lot of extrinsic value in them, and that's why you see the difference between the white line and the red line. So this is for the at the money option. I'm going to look at the in the money, which was the 510. And for the 510, you can see that we're going to pay a lot of money for this option. So right now, Apple is at about 467, but then this put option is at 510. So this is where, and whenever you see an angle like this on your risk graph, you know that you have chosen a strike price at that point. So in this particular case, we have the 510 put option. In the 510 put option, we paid a premium of 46.40. Therefore, our break even is going to be 510 minus 46.40, and that's exactly what you'll see. You'll see that you have your break even at 463. So just like we saw in the call options, Apple's currently at 467. And if you bought this 510 in the money put option, then you can see that you have very little to move. So as long as Apple moves just this much, you're going to see profits accumulating. And so that's the advantage of in the money options. However, in the money options are going to be very expensive. So in general, you would not buy in the money options at all. You're going to come closer to at the money. And so these are all tactical issues which I'm not going to get into in this course. Of course, from the next, when we tackle, once we finish the theory, then we have actual trading courses, and that's where trading strategy and tactics and all of that comes into play. So this is as far as the in the money put option. Now I'm going to look at the 425, which is the out of the money put option. And you can see that in this case, we are paying only $2.64 for this option. Therefore, our risk on this trade is only 2,640 because we have 1,000 shares. 10 contracts is 1,000 shares, and our risk on that trade is 2,640, and that's going to be the maximum loss. However, for this option to be profitable, Apple has to move from 467 all the way up to 425, and then you can see the line changes direction. So we have a strike here, and that's at the strike price of 425, and it has to move by an amount of the premium. So the strike price minus the premium, your break even is going to be about $422. So what are the chances that this option is going to do well on the day of expiry? Well, it's got to move from 467 all the way to 422. So that's a pretty big move. However, if you wanted to see what will happen to this option if Apple made a move today or tomorrow, Then you look at the white line. So if Apple made a $10 move today or tomorrow, you can see that um, your profit is going to be about $1,600. And this is another feature you may have noticed in the previous case. In the at the money option, we saw that if Apple moved $10, our profit was going to be about $4,000. Whereas in the out of the money option, the profit is going to be less. And that's because out of the money options are going to move slower than at the money options, and at the money options are going to move slower than in the money options. But these concepts are going to become very clear when we deal with option Greeks, because option Greeks dictate how each option moves with relation to the underlying stock. So that's as far as these risk graphs are concerned. In this lecture, I wanted to cover these three options. And if you look at if you look at the intrinsic and extrinsic value, I also wanted to cover that. And I also introduced a pattern here in terms of the intrinsic and extrinsic values. Extrinsic values are highest for at the money options. So again, these are all concepts that we'll be visiting in future courses. So don't worry if you haven't got anything. I'm just giving you a flavor for some of these topics, because these are all extremely important topics and we'll be covering them in later courses.